Hi everyone across the pond. This is Michelle Schneider, Chief Strategist of MarketGauge, bringing you a video today on commodities, as I still very much believe that the super cycle of commodities is really just getting going. Now, of course, there are a lot of talk by many analysts that the dollar has the key relationship to commodities trading. There is a relationship, but there has been plenty of times historically where the dollar has gone up and gold has gone up. What is so interesting right now in the U.S. environment is that the yields have actually risen a little bit, as people believe that the Fed will continue to hike, maybe even by a quarter. And at the same time, we're seeing a flight to safety to gold. And so I thought we would really examine here first the dollar, because if it collapses, of course, that's going to have an impact on everything. If it stabilizes, it may not have much of an impact on anything. And of course, if the dollar proceeds to rise from here, that could have some negative impact, unless, of course, we're seeing the type of inflation that the dollar and the Federal Reserve cannot control. So this is a very interesting chart. This is the euro to the USD, and we are sitting right on the 50-day moving average right here. And so as a result of that, right now we are still in a bullish phase, in that the euro to US dollar is still in a bullish phase, and we're looking at it trading between 107 to 109 against the euro. So that tells me, with an inside day as the day that I'm recording this on this 50-day moving average, if we can get back over 109, it's very likely we will see some kind of pop in the dollar. So it's something to keep your eyes on. It also could affect equity prices. And in the converse situation, if we break down under 1.07 to the euro, then that might mean we'll take a quick trip to 105 and possibly even lower down to around 100. In which case, I think we would continue to see, especially precious metals prices, rise. Now you can see here the ratio and the leadership is versus gold. So I wouldn't necessarily take this to heart too much, but right now both of the currencies, the euro and the dollar, are underperforming gold, because that has become the safety play of late after the banking crisis. So I'm all about ratios this week, because I think these key ratios are telling a story. So you could see the dollar euro not really telling that much of a story, except for the fact that the dollar could actually go up against the euro or down. I mean, really, if we're talking about trading ranges, that's classic. But to me, the more interesting ratio right here is what we're seeing with the silver to gold. Now, there are many ways to measure the silver to gold ratio. I'm just looking at this on a pure daily chart play, and the bottom leadership indicator, one of our proprietary indicators at MarketGauge, showing that silver is gaining momentum in its leadership against gold, clearing the Bollinger Band. So that is significant. Is it at the highs? No. But what is significant about it is that it's telling us, regardless of the yields that are obviously going up a little bit, the dollar, which is not necessarily going up but holding firm, the silver, which is both an industrial metal and also a hedge against inflation, is showing consumer demand rising, perhaps not enough supply. And more importantly, it is a good inflation indicator when it does start to outperform gold, because gold has been going up flight to safety, but when silver goes up and outperforms, that's when we start to have to wonder about inflation. So just looking at the pure silver chart, you can see we're in a bullish phase. We've gathered a little bit of steam away from the 50-day moving average. Obviously, we have not gotten through these highs that we had in the beginning of the year. And if we do, many people think that this is going to continue to go up, possibly back to $30, $35, or even $40 an ounce if you're looking at the pure physical price. To me, what's more important here is the fact that this ratio is telling me one thing, and that is that inflation by no means has been defeated. So the third ratio, which is probably one of the more important ratios as well, is the TLT, or the long bonds ratio, compared to the SPY. Now, the reason why I'm mentioning this is because this does impact commodities as well. So we could see already inflationary signs with silver. We can see the dollar is sort of more agnostic. But in terms of the bonds versus the SPY, when it's outperforming, when the long bonds are outperforming, generally that's a recessionary tone, right? Because it means that the rates could kill the SPY. However, what we're seeing is the opposite now, with the rates and the yields actually rising as the TLTs break down under the 50 and starting to slightly underperform the SPY, which means that the market is sort of saying maybe we've averted recession, and instead these yields may go a little bit higher, but they're not necessarily going to go, say, to where we were here when we had this island bottom, which could in essence wind up being good for some level of economic growth. Of course, all of which to me still signals, unless the yields go screaming higher, that commodities could grow if money is starting to come into the economy. So these are all the picture here. We've got inflation. We still basically have stagnation, which is better than recession. And of course, we have, again, an agnostic dollar. So let's move on now to some of the softs, because I'm finding those to be particularly interesting. I'm going to start with sugar futures because this won't be the first time you've heard me discuss sugar futures. And I'm now looking at my TradeStation view instead of stock charts, which we still have some of the same indicators on, namely our real motion or our momentum indicators, which right now you can see shows that sugar is not necessarily having the momentum that the price is, but it is still in a positive territory. And if the momentum clears back over these Bollinger Bands, while the price looks like it's going to skyrocket on to new multi-year highs, that's going to be significant. Why? Because sugar is one of those insidious raw materials that's in everything. It's considered a luxury item, and it also sometimes is a precursor to seeing social unrest and more food shortages. Now that's on a daily time frame. If we look on a weekly time frame, you can see that this is just consolidating here, doing very, very well. And probably the most interesting time frame to me right now is on the monthly one, because we broke out of that 80 monthly, we tested it, we did a little bit of consolidation, and then back in November, we've been really in a pretty serious uptrend with no major resistance in sugar to about 24 or 25 cents a pound. This is the continuous contract. But it's the implication of it that's most interesting to me, and that's why we really have to look also at DVA, because DVA is a composite of not only interest rates, which it seems to be ignoring right now, the bit of a higher yields, but also the grains. And the wheat and the corn and the soybeans have all looked like they have bottomed. We actually were a buyer of DBA at lower levels last week because in terms of chart patterns, this was a new 60-day low that was followed by a reversal pattern and a close above the day before's high, which generally means you get this super tight risk to under the low of that day. And if we blow this up a little bit and look at the real motion indicator, that too, you have a 50-day crossing over the 200, so it's in divergence to the price. The 50 is under the 200 in price, the 50 is above the 200 in momentum, and it looks like the momentum is just starting to get going. Obviously, if the momentum takes out the most recent highs and this continues to chug along over, let's say, 2040, 2050, that tells you also, forget about what anybody's saying about deflation. This is a super cycle of inflation, and between the sugar prices, the silver prices, and what I'm going to show you in a moment in the oil prices, this could all mean that equities could have a run for a while, and then the Fed will be forced to be more aggressive. On the weekly basis, of course, we have to get through that 2050. Why? Because here is your 50-week moving average. But again, going out to time frame, and I'm loving these monthly moving averages this year. We're on the 23-month, we've well cleared the 80-month, and we certainly have room to get back up to the highs that we saw back in last year, a year ago in April, up at around 22, 23. Now, of course, no picture of commodities is complete without looking at crude oil. And instead of looking at futures, I find it very easy to track the USO which is the United States Oil Fund. As you know, we've depleted a lot of our strategic reserves. And of course, there's news, OPEC Plus now saying that they're not going to cut production anymore. Russia is keeping the same in terms of production, deals being made on the side between the Middle East and Russia and China. Also a concern about supply. So here we go. We've got a nice basing action here. If we look at the weekly time frame, we really basically held where we broke out of in 2022 when we got down to 58, and we're above that now. We're above the 200 week. We're going to be coming into some resistance here, so it's possible that on a weekly and a daily basis, we're just more range bound, say between $65 and $85 a barrel. Obviously, if we're looking at prices per barrel, we clear 75, which would probably put us somewhere around over $100 a barrel. Then I think we have to worry, really worry more about inflation, but have a party buying the futures in some of these commodities. Now, let's take a look here at the monthly chart. Also very telling, because we had an extremely short period of time above the 80 monthly back in 2022. We immediately broke that. But we've never on a monthly basis since the major breakout here in 2021 closed below the 23 months. So as we're ending March, I would say probably one of the best pieces of advice I could give you is to keep your eye on this 23 month, which is right here, very close to where we're trading currently, or let's call it 64.45, 64.50, just to round up. We get a March close over 64.50. It's saying that this correction is over. That's how I would look at it. And it's time to take a test up to the 80-month moving average. And finally, probably the most boring in terms of the energy sector here is natural gas, and people are saying it's getting to the point where it's ridiculously cheap. One thing I know as a commodities trader is that things that look cheap can get cheaper, things that are expensive can get more expensive. But maybe the most interesting part of the natural gas, again, takes us to this monthly chart, because in the monthly chart, we have our 80-month moving average, obviously you can see above here. And again, so it's just like with oil. We got above the 80-month moving average and came back down. We're below the 23 months, so this is much weaker than what crude oil is. Thanks so much for watching. Bye for now.